Sandy is an example of the disasters we can expect to have more of in the future. It's, in a sense, it represents a little bit the future of disaster and also the future challenge for risk management. We increasingly live in interconnected urban societies that depend on rapid data transmission, on a series of interconnected networks and so on. And it's for me, I think one of the fascinating things about Sandy is actually seeing how probably the indirect impacts, due to power outages, concatenated failures in urban systems, were probably far more significant than actually the direct impacts in terms of, damaged and destroyed buildings. And as I said, as our societies do become increasingly urban, interconnected and dependent on interconnected banking, air traffic, financial and other systems, I think this is the kind of disaster we're going to see more and more of. These are the risks as well, which I think really up to now haven't been well modeled. So we're really looking into the dark when we look at these risks, and I still don't think we've also worked out how to manage them properly either. Insurance is an absolutely key component of disaster resilience. And that's at any level you want to describe it, from a household that's insuring its property, to a business which is insuring its commercial assets, to a country which maybe wants to insure its sovereign risk and all the contingent liabilities it has in schools, hospitals, roads, bridges, and so on and so forth. Insurance, really enables those risks to be spread over time and shared in a way which enables, as I said, anything from a household to a country to really buffer those losses. So it's, from that point of view, it's extremely important. But we always stress that it can only ever be one part of a much broader package of disaster risk management measures. If the pricing is correct, insurance can certainly encourage, let's say, risk-averse behavior. Unfortunately, we know from experience that actually getting the insurance pricing right and working in that way is still a challenge. We do global risk modeling, and we've really modeled what are the factors that lead to countries having or not having very, very high mortality risk. The key factors are poverty. The lower a country's GDP, the higher it's likely to have its mortality risk, which is, again, it's not very difficult to understand. It's just development. And from that perspective, I mean, Japan is going to have a far higher proportion of its buildings built to seismic resistance standards. Haiti will have an extremely low proportion. But it's not just poverty. It also has to do with how governments and societies are organized, which is, generally these days bundled under a word called governance. So countries that, have very, let's say, weak governance, the rule of law isn't really applied, there's poor coordination between central and local government and communities, again, are much more likely to have far higher vulnerability and far higher mortality. And in a sense, Japan and Haiti are two extremes on that spectrum. I mean, despite the sort of mortality that happened in the East Japan earthquake and tsunami of 2011, if a similar event had happened in most other countries, it would have been, greater by several orders of magnitude. But there are some, I would say, let's say, nascent or incipient good practices which are starting to come on stream. A number of governments around the world now introducing a screening of all public investment projects for their disaster risk before, in a sense, the check is written from the finance ministry. And this, can potentially have an enormous impact on risk levels in 20, 30, 40 years' time. If a typical medium-income country is spending, let's say, $10 or $15 billion a year on public investment, schools, roads, bridges, hospitals, etc., if it starts right now really screening those projects and making sure that they're, in a sense, disaster-proof, it'll mean that, again, in 40 years' time, the stock of infrastructure in that country will be increasingly disaster-proofed. And we also see, in the private sector, a gradual move now from doing business continuity planning, which is really the private sector's equivalent of disaster preparedness and response, to actually, again, looking at the risks in their investments, in the investments they're making. So, again, all those companies who obviously invested, hundreds of millions of dollars in building factories in the floodplains of Thailand, are probably now going to think again when they make similar investments in low or middle income countries.